the model for our business right now is really around that sleep at night factor we love to be able to provide to people, right? So we've got that capital city strategy for the most part,
Yep.
which
Yep.
we all kind of live and breathe by.
Yep.
We're not 1 year strategy people. We're 7,
No
10,
flipping.
15, 20
No.
year, none of that
Yep.
stuff. So it's about buying good quality properties, good quality markets. We know we're getting the right pressures.
You're listening to Property Investor Tales, stories from the front yard. Here's your host, Tabitha Bright.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name's Tabitha Bright and I'm the head of coaching here at Positive Real Estate, where we help people build wealth through property. With over 8,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your investing journey that little bit easier and will inspire you along the way. So my guest today is Brennan Latimer. And Brennan talks about how he learned the power of starting early, about investing versus buying your own home, which is a question a lot of clients asked us. What's best? What's the best way to go forward? Do you trade investing for buying the home of your dreams or being able to get into the housing market for your first house? And we also talk through trading quality in major capital cities for cash flow in regional markets and what those trade-offs are. So enjoy this conversation with Brennan. Hey everybody, welcome to today's podcast. I'm super lucky to have the fabulous Brennan Latimer with me today. And Brennan works across two of our businesses here at Positive Real Estate, R&W Group and Positive Real Estate. And he's involved in both development and acquisitions. So our acquisitions team are the team that go out and locate great deals for our clients. So we're going to talk a little bit about that today. But before I hand Brennan the mic, I also wanted to touch on Brennan's background because tell us a little bit about your background, Brenno. You've got qualifications in property.
Yeah.
Explain that. Yeah.
Yeah, oh God, I think I'm coming up to my 13th or 14th year with the Positive Group as a collective. Yeah, so it amazes me every time I say that, basically. But for me, look, I've always been about real estate and really liked real estate. I'm a very linear thinking kind of person, quite black and white, factual, and real estate's tangible. I like that compared to playing the other game of equities and all that sort of stuff with investing.
Yep.
So I've always been about real estate. So look, I went and I studied a Bachelor of Property Economics at UTS, University of Technology in Sydney, which is kind of like an economics degree majoring in property, so to speak.
Yep.
Right.
Right.
And then actually in my final year is when I started working directly under Sam Saggers, doing buyer's agency deals in all sorts of parts of the country.
Yeah.
So that was my first foray into real estate, basically working under Sam. And everyone will know listening, really, really amazing guy, a very prominent figure in the market, a unique take on everything, great person to work for. So here I am, some 13, 14 years later, still part of the team and loving it.
Oh, yeah. Fantastic. Oh, awesome to, hear that you've got those qualifications behind you as well, because it gives you that good foundation, which is fantastic.
And beyond that, that you sort of fall into getting your certificate of registration, then getting your full license on class 1 license as a director of a couple of businesses, of our sales businesses. And look, in between that, Positive Real Estate's pretty good. We've gone and got Cert 4s for business management, Cert 4s in finance, gone and got various legal qualifications, so we know what we're talking about with contracts and things like that as well. So quite a few qualifications. And that's really good. Actually, the Positive team really encourage that. So like you speak to most people and they've got a really good array of qualifications actually behind them, which is, pretty cool.
Yeah, no, that's awesome. Because a lot of people, when it comes to property investing, are self-taught. And there's certainly an aspect of that for myself. And, we talk about learning by trial and error and actually getting coaching and mentoring. Once again, I've done both. I certainly learned by some trial and error in the early days.
Yeah, me too.
And,
Me too.
yeah. So tell us about that. Tell us about your investing.
We'll touch on that later. Oh, look, I guess it stems from my first property deal, was a pretty interesting one.
Tell us.
You know, the model for our business right now is really around that sleep at night factor we love to be able to provide to people, right? So we've got that capital city strategy for the most part, which we all kind of live and breathe by. We're not 1 year strategy people. We're 7, 10, 15, 20 year, none of that stuff. So it's about buying good quality properties, good quality markets. We know we're getting the right pressures. And look, hey, my first property, I was off in Gunnedah in regional New South Wales. Now the market, not so bad. We've done some deals with clients in there. There's been some growth, not as much as we'd hoped. Really good cash flow to it as well. But look, I kind of had blinkers on. You sometimes people fall in love with a deal and all they can see is the potential positives in it, right? And golden rule, just neglected some really basic due diligence. So you're familiar with black soil or soil types. So the black soil is probably the most volatile, movement-orientated soil that there is.
Oh, you just taught me something.
Yeah. So where I bought, so Gunnedah is a pretty fruitful farming agricultural region, and the reason I bought there was quite a speculative play. Shenhua's a large Chinese mining group had found some of the richest coal deposits in the Gunnedah Basin there, and it went from government green light to red light to green light to red light in terms of lobbying and everything. So it never actually really properly kicked off the ground. So the merits of my speculative play didn't come to fruition. But I got a little bit of growth after about 7 years. Basically, after I paid my tax with relation to depreciation, I claimed there was pretty much a couple of bucks. The cash flow was really good on it, which allowed me to have basically a second income because I had some good savings set in the offset account.
Oh yeah, great.
But during the course, I've got less hair in my head because of this property.
Why?
Doors would be swinging, cracking all over the place, pipes cracking, plumbing stopping, multiple times, battling the builder to get them to come out and do some more ag work around the house to alleviate a bit of moisture and movement. And I remember, the builder had brought it up at the beginning, and all I could see was, hey, so what it was 1,000 square meters, 2,000 square meters. I split 2 blocks, built 2 houses, still strata title, but 2 fully freestanding big houses. And I had in this figure, it was like, geez, there's a 20% growth on that with a 6.5% return. And I just ignored everything in between.
Gotcha.
So that, they were like, this soil's pretty active. Hey, I was like, well, let's do peering. So we did peering. But of course, it just wasn't enough. So yeah, bit of a headache asset, and it was really hard to sell because of that reason. That street was pretty well known for having that active soil, and it was a pretty tough sell. So that was a really, really good lesson to learn for such a basic fundamental. 2 reasons: listen to what people are telling you. Make sure you do your due diligence right down to the nitty gritty.
Yeah.
And secondly, the opportunity cost on that real estate for me, if I'd conversely gone and put that was a $750,000, $800,000 total deal 10 years ago into the Sydney, Brisbane, Melbourne market, and just on a house.
Something basic.
We're talking about, at this point in time, 10, 12 years later, anywhere from doubling to 2.5 times. So, that's why I think what we're doing now as a group and looking at capital cities, but which capital cities and why, and then diving into which locations within those cities, and always pushing people to have a diversity of property types in different locations is super important. So I can always definitely tell people, not everybody who does property is an absolute superstar winner. They've got some horrible stories behind them. The next property I did absolutely killed it in Newcastle, doing a duplex. So following a similar sort of strategy, that's kind of nearly doubled in value and now spitting off about a 7-8% return for me over the last 8 years. So your lessons are learned. I definitely asked the builder what the soil type was when I did that next duplex.
You did.
Yeah.
It's funny.
Yeah.
It's interesting because I think you're right. I think everybody that's invested in property, if they have started off their own volition, they have a few bumps and scrapes to tell. I have a similar story, and I'm adding it here because it's important to understand trade-off, and it's important to understand what Brennan was saying about falling in love with the deal, because I see so many clients that fall in love with the positive aspects of something without understanding or allowing or weighting the trade-off. So whenever we're coaching here at Positive Real Estate, we talk about upside and trade-off, because no deal comes with only upside. There is always trade-off. And then it's just a matter of understanding how you mitigate that risk, and are you comfortable with that risk, because the trade-off is enough that you proceed. And I remember we had a similar story, Brennan. We did a number of deals. We did a couple in New Zealand that had crazy yields, like 15% yields and stuff. And I got so caught up on that. I'd read Robert Kiyosaki in the 90s.
Yeah, I'm going to retire off cash flow and not have to do anything.
Flow. Who cares about the capital growth? It's all about the cash flow. And I realized I was going to have something like 200 properties to retire myself on the income that I was after.
And then are you a slumlord, and what kind of maintenance is there? And
I rented to the student population in Dunedin, and this isn't to by any means malign the Dunedin, the town of Dunedin. It's a beautiful city, but it's well known for its partying hard student population. They take over the streets at it's like spring break on steroids in New Zealand. So it goes nuts, and they are renowned for ripping up floorboards and lighting fires to keep warm in winter. It's nuts. So we had properties there.
How's the landlord insurance on that? That would be fun.
I've got so many stories about those properties, but it was the same thing, Breno. We poured a whole heap of our cash. We had a business back then. We had a graphic design business. We were getting dividends. It was like, we're going to buy property with the dividends. We were throwing it into property, chasing cash flow. And if we'd bought the house bloody across the road, I'd have a couple of $1 million in my pocket right now. Compared to when we sold them 7-8 years later, and we netted probably.
Sometimes it really is that KISS method, right? Keep it simple, stupid. Like, honestly, some of the people I know that have done the best in real estate are not even real estate minded people. It's not their true passion or work. They just had this mentality of like, I'll buy real estate when I can. And bought a house, no fuss, no analysis paralysis, and they've just crushed it. They bought a house in Sydney or Melbourne or Brisbane where they lived or what they knew when they could 10 years ago, and just got on with it. Just
good
really
quality.
So funny that.
You're bang on. And I often say to people when we're coaching them, it's that is an awesome point, Breno, because people always look for the secret source or the information that nobody else has, and while there can be a little element in that, that, it is buying good quality real estate and holding. And people get so bored with property. Sam talks about it all the time, right? And so have you bought and sold a lot, or you've held? What are your biggest kind of lessons and regrets and wins outside of Newcastle?
Look, so obviously I could have done better in terms of location, and that original sort of 750, 800 investment I made. I was like 23 at the time when I made that, I think, quite young, 24 maybe. I'd made a bit of money in the share market. That's where I got some luck to have this money behind me, and
that's awesome.
Shares wasn't for me. So I actually sold down like 90% of that holding to do real estate. I was all about it at that point in time, working in the positive crew, getting mentored from various people. And look, so that one was a bit of a mistake. The next one for me was Newcastle, which is still a market that we do some work in. I'm a big fan of that marketplace. Like the assets, I've got 2 3-bedroom townhouses still there now.
Awesome.
So I look, I've really basically never had a day's vacancy. The rent's always gone up. And even in periods in the last decade where we've had some, minute peaks and troughs in our greater market of, like election time and APRA time, 5 years ago and stuff like that, they really just, plateaued for a brief splint period in time and then carried on doing it. So I'm holding on those. For me, my strategy was I had the Gunnedah properties that were paying cash flow, did a
Yep.
better piece of real estate with the Newcastle, which was going really
Great.
well.
Perfect.
Then I actually just recently, a couple of years ago, purchased a home in Sydney.
Yep.
So I got married. I've got 2 kids now, so it was setting up for that nesting kind of phase,
Of
if you will.
course.
So I needed to sell the Gunnedah properties in the lead up to doing that, basically. So kind of, Jason talks about this. You're migrating your money. Essentially, that asset did help me to do it at the end of the day, but it had kind of reached its ceiling of usefulness to me and for what I needed in my life. But look, the aim for me, house here in Sydney, pay it down as I can. I utilised the equity out of my Newcastle properties to purchase my home here in Sydney. So win-win-win.
Yep.
They've still got great depreciation on them today, and they're always increasing in rent. So they are positively cash flows to help pay a little bit of my mortgage off.
Yep.
And I intend to hold on to those forever. So I've got a strategy to pay off my home in the next 10 to 15, then spend another 10 to pay off those assets.
Yep.
That's pretty much retirement time, and 100K passive income off two properties in Newcastle, along with a super, should put me in a position to be able to actually consider like a semi-retirement at that kind of age. So mapped out a little bit of a roadwork, which is what you guys encourage with all the clients. Like, have some sort of steps to do it. Hold yourself accountable. Definitely doing the exact same kind of thing. And for me, more property. Like, I've still got a share portfolio. It's like $50,000 to $60,000 on any good or bad day, but I don't even look at it. It's no point in looking at it. It's just sitting there. And my next property, I still want to do some more real estate, even when I can. I've got to improve my serviceability a little bit. And then I'd love to go. I still really love the idea of doing like maybe a house up in either some part of the Southeast Queensland market, or like a really selective purchase down in Melbourne as well, just for continued long-term, forever hold as well. So kind of
definitely buy in Melbourne.
Exactly. We'll practice what we preach, right? So it's same merits for me. Just buy some good stuff to hold on to forever. That's it.
And it's an important part of any client strategy. Even if a lot of clients choose to rent invest, so they'll rent and then invest, and that can be due to their personal circumstances and the cost of getting a family home. Like Brenno, you'd obviously built up some assets which allowed you to buy a beautiful home in Sydney in a premium area. And the price points of property like that is not to be sneezed at. And you've taken a big step to providing financial security for yourself and your family with that, because it's so easy to get bought out of the market. And I always think, we've got a really lovely home. We're super lucky in a beautiful blue chip spot in Melbourne. But it's a single fronted, it's 3-bedroom, 2-bathroom, single fronted brick Edwardian property. And we looked at, at various stages, because I'm in my 50s, and at various stages along the journey, we looked at
should we
trading
sell
up. But we chose to buy more investment property. And now I sort of go, well, I don't, like, if I was to buy a double fronted house in this area on a decent block of land, like, I'm looking, there's one going around for sale at the moment, that's $4.5 million that they want for that. So I just think, but if I had invested in that, let's say 15 years ago, I've had this place 20 odd years. I bought it for was just under 400,000. I bought this.
Oh, awesome!
I know.
That's the time in the market right there.
But I could have bought a double fronted for 7, and I thought, I'll go the 4. Call it 400. I'll go the 400, and I'll buy a whole lot of investment property. And I just think, oh man, I probably should have, and I try not to think about it, but I probably should have bought the big double fronted. So congratulations on your purchase.
But okay, I guess as well, it's there's always the shoulda, coulda, woulda. We could sit down and play all day, right?
Always.
But at the end of the day, you would have diversified and still had some wins from the other assets that you did buy instead of the big one. But
Yeah.
But hey, look, I can tell you this: I've got 700 squares. I've got a 4-bedroom home on there, and
Yep.
I already cannot wait to downsize. I don't know when that's going to be, but like every weekend, the maintenance, the upkeep, the creaks,
Yeah.
the cracks, the things that go wrong. So like,
Yeah.
I can totally understand this movement over the next 20 years of
To
people. Like,
downsize.
I work 50 plus hours a week. I've got 2 kids. The weekends are smashed with just activities and stuff. Like, people, like the shrink is definitely going to be on, because you won't see people buying big houses in another 5 to 10 years unless they can pay for the cleaner frequently and pay for the garden maintenance frequently. And people's cash flows are getting squeezed at the moment. So yeah, it's interesting. You know, I think you probably would have been living in your big house now, but thinking, shit, I wish I had a smaller place that's so much easier
Is
maintenance.
probably.
So the grass is always greener.
Oh, look, I tell you what, you know, when you're getting old, because there's many of you guys know if you watch these podcasts, I love my running, but I am getting, you know, some running injuries. And now that I've got to go up the stairs to the bedroom, tell you what, in the next 10 years, that's not going to be so attractive. The only thing I'd say is if you're looking
Get the
long term,
inclinator. Get the
one level.
inclinator up the stairs.
Oh, no. I hope I never have to do that. But anyway, we joke. Yeah, look, whatever you choose to do, whether you choose to rent vest, whether you choose to do what I've done and spread your diversification, whether you're a little bit more focused with where you put your money, like what Brennan's chosen to do, you know, there's so many ways to make money out of real estate.
Yeah,
and I think
100%.
what I love about real estate is that it gives you that feeling of control that maybe you don't get with the share market. You know, you can do a reno,
correct.
you can, you know, physically put your rents up. You can do, you just have a little bit more control than just being a shareholder. And I really like that about real estate.
Slower moving rates of decline and or growth, you know. But
sometimes,
yeah, ultimately it's that. And look, you know, we talk about buying houses and things like that, and I must say, just taking a bit of a tangent, what's interesting to watch at the moment is, you know, we've got such an outcry of you know, anywhere from 20 to 35-year-olds, 40-year-olds, sort of obviously pretty upset about the concept of buying houses in the market now. That you know, dream of the Australian dream is really tough, you know, not really achievable for the masses. Brings about a very interesting conversation for the future of real estate in Australia shrinking, and you know, people renting forever being much more common than it is now.
Yep.
But what is interesting is I have to say to people that, like, even some of my mates who haven't bought a home yet, I'm 35 years old, they might even be doing exceptionally well at work, haven't bought real estate, don't necessarily have any decent assets to them. There's this trend at the moment, which is so frustrating, of like, oh, I can't buy the home, right? Piss it up against the wall. And it's so stupid, and it's happening everywhere. Like, and not to sound like an old man, but like, there are so many of these, like, up to 35-year-olds that are going out multiple times a week, spending up big, partying, you know, getting on those recreational drugs, which aren't cheap, trips here, there, and everywhere, and it's and the gambling and stuff like that. There's some pretty interesting things popping around on Instagram about how dumb it is and stuff like that, with some tradies doing some stuff a bit funny. But you know, it's so silly because you can go and buy something that can at least do some good by you. Like, we're working on a deal in Canberra. You can get into a deal there with $25,000. Now, you settle it in 2 years' time, it's going to be paying you an income to hold it, typically, these ones we've got. And you can service that on an $80,000 a year salary, which is most people out there, you know, it's like, namely here in Sydney. So you can at least do something rather than give up and sit there and then whinge and be a forever renter. Now, of course, it is totally circumstantial, and not everyone is able to do it, and still it's tough to save 30 grand, 50 grand, what you need for the purchase. But yeah, it's interesting. Like, there should be a lot more younger people buying real estate, and that would be the biggest regret of mine, actually, just not doing more when I could. That's 100% the regret of mine. And so many people sit on the fence for so long, right? But and they have that analysis paralysis. And it's, for me, real estate, the best thing to consider is just buying what you can when you can, but not anything, obviously. Do some due diligence and get
the
into
best you can for your money. Yes.
Correct. Get into some staple markets and things like that, obviously. But you know, Australia is an absolute beast. We've got continuing pressures coming in here, big demand and supply issues at the moment. growing economy. You know, we're favored by the rest of the world in terms of a place to live, work, and play.
Yep.
We're only going to have more pressure and more increases on the price in our real estate. So like people can sit and bitch and moan about it, or get into some sort of deal somewhere that makes sense. So yeah, that's probably my prevailing message as well to most people that I talk to and have this kind of conversation. Just do what you can when you can. Yeah, because I think we've all been guilty of it. Like, I know I didn't buy in Sydney when I could have. I was thinking of doing the home, and like my old man is quite conservative. He's a accountant background, did very well, but he was like, that's a lot of young debt. That's a lot of debt for a young man, and I didn't buy it. And then I became one of those people that was like, oh, it's too expensive every year. It's too expensive. It's got to come down. It's got to come down. It's got to come down every single year until it got to the point that it's got to now. And you know, why we might have some blips. Like the home I've just bought recently has probably dropped about, this is a great point to consider. I bought this home to live in for at least the next 10 to 15 years. That's my time frame. I've probably lost about $200,000 on this home since I bought it, just given what's happened in the city in the last. I don't care.
Yeah.
I don't care, because I know that the real estate market goes like this here in this country.
It does.
On that
and
upward
it's already
trajectory.
beginning to recover.
And it's already doing that. So I know this time next year, I'm probably going to be feeling a bit better about myself and being back to what the property was that I paid for it. And then the end of next year, who knows what it's going to be? I might be 5% up as well. So yeah, you know, it's about sort of time in the market more than rather than timing the market.
It is true. And as you know, as someone that has held, and I'll use this home as an example, like, you know, we bought it for just under 400. I was so annoyed when I bought it because it was a boom. It was in the boom. I'd sat on,
it's all relative, isn't it? Which boom?
That was the end of the 90. Do you remember the market went off in 97? Yeah. And we bought in 2000. And I remember we'd landed in Australia from New Zealand, and I was looking around at all the houses, and we were saving feverishly for a deposit. And I literally arrived in Australia with 3 T-shirts, 1 pair of jeans, and that was it. That was it. I was negative 3,000.
I hope you had a jumper for Melbourne.
I didn't. We were negative $3,000 that I had to put on a credit card for the bond for an apartment. Like, we had nothing. We'd just done a big trip overseas, so we went, stuff it. We're just going to land here and do whatever we can to get in a good position.
Yeah,
and
that's awesome.
Yeah, it was very funny. We had to save for our first washing machine because I didn't want any more debt. Because I was thinking like that about debt. And we eventually saved enough for a house, which was this house. And I remember going around to some of the properties in South Yarra and all of that and arguing with agents because they were selling them at that point in time for $300,000 and in $250,000. And I was going, it's gone up too much. The market's going to go down. They were like, it's not, mate. You better get. I was like, I was having these full-on fisticuffs with these agents going, market's going to drop. I knew nothing. I was just making that shit up. But I thought if it goes up that fast, it must come down again. And I didn't. And then I ended up spending, call it 400 because I didn't get in fast enough. But now, and I was kicking myself. I was like, I have spent too much on this property. I've overpaid. What an idiot. And, you know, now probably $2.5 million. So it's not a $4 million property. It's a single fronted, but I've held it since 2001. Yeah. And
it's such a good point because we say this all the time. People are like, oh, it's kind of peaking. And you're like, well, you know, maybe it is. It's all relative to every individual market. But even when you're having this discussion, people are like, oh, it's too expensive. You know, the market's too expensive. And you go, oh, well, look, you know, I don't think the guy or girl who bought in the last boom, you know, pre-GFC, are upset with themselves. They probably were during the GFC, but then they pretty quickly were probably pretty bloody happy from 2014 to 2017 before the dip happened again. Then it started going up again. So we're having a little bit of a dip now, and it's going to go up again now. So yeah, it's all a matter of that time in the market.
It really is. And the ability to hold, and, you know, maybe you spent $200K more to secure that property, but there's so little stock on the market at the moment, Brenno, you know that. And you will not be telling yourself you will not be regretting it. I know you're not already, but
Yeah.
10 years down the track where that property's doubled and no one can afford to get into that market.
Yeah, 100%, 100%.
Yeah.
And it's an interesting thought, the future of
Yeah.
Australia. And I know Sam talks about it all the time. And
Yeah.
actually, sometimes it's quite scary to think about what
Oh, it is.
20 years will look like in
Yeah.
not only Sydney, but all our capitals and actually around the world, with the bit of displacement going on, socioeconomic sort of displacement.
Yep.
And I don't, obviously, home buying and owning is going to be a thing of sitting with 10% of the population in the future, because the government's going to have to start putting more property out there just to get people under shelter. And we're already seeing that come through with big groups with support from the government doing like build to rent and stuff like that. So imagine in 10 years time where 50% of the real estate that's being produced is build to rent. There's going to be fewer owner occupier properties out there, which will actually probably conversely increase their value because there'll be lesser demand, so much strong demand on them and stuff like that. So it's a crazy thing to think about what the next 10 to 20 years looks like for real estate, not only here but everywhere. Yeah, but it's definitely scary right now. And like, I put stuff on LinkedIn and to our group all the time about some media articles, but there's no end in sight for the rent rises that we've been seeing. Now, maybe it'll slow down a little bit.
Yeah, government.
Right. I think the rate of growth over the next few years, when it does start growing again, is still going to be relatively subdued compared to the last few years. But there's no signs for it to slow down. There's no real estate. Like, my job is to go and list real estate. Any market I can pluck, and I can take a look at how many DAs are in play there. Not many DAs in play. And are they even going to be able to get off the ground? There's only a handful of builders in Southeast Queensland right now that can even do any form of medium to high density residential development apartments. And you know what they're doing? They're saying, hey, you want to get me to build this? This is my risk at the moment. This is my price. Hey, all of a sudden, that development doesn't stack, so it's getting laid, put on the back burner and laying dormant. Ergo, we've got no supply coming through. So, it's a really interesting dynamic at the moment, but all things are pointing to like tighter elements of supply until we get some sort of change in the wind of the market. And rents and prices, I think, are sitting there to go up pretty quick.
Yeah. So just following that train of thought, I know, some people do want the family home, and they do want, they do want a beautiful place. And I get that drive, that need to have a space that feels, like it gives back to you. It's just somewhere that's got a fabulous energy to live. I understand that, but I do encourage people, if you, like you were saying, Brenno, if you cannot get the property that is your dream home, then make sure you're looking at rent vesting. Make sure you're looking. I mean, we never bought this place to be our forever home. It was just that we ended up investing everywhere else, and then other stuff got in the way. And we had our daughter early. She's in her 30s. She's left home. I don't actually need anything bigger than this. I hate my neighbours.
Exactly.
But that's a story for another day.
The partying tenants, isn't it?
The party. Oh, I've got lovely neighbours this side, terrible neighbours at the back.
Yeah, right. Okay.
That party too much. But all of that aside, they're not really big challenges. So we've been very fortunate. But we've worked for it, and we've chosen where we put our resources, as has Brennan. But don't let not being perfect stop you. Make sure you learn. There's forums, there's places like Positive Real Estate. There's, Brennan, you've got your LinkedIn where you put lots of information. Do you have other sources where I know you do videos?
Yeah, that's probably my most active one, where I like to just put some content, anywhere from 1 to 5 times a week, just getting some really great content out there, and market insights and stuff about deals and successful stories and things like that. So it's a great place to look. But look, even if you're not buying real estate for another year because you're in your saving phase, like, that's where joining PRE on one of the mentoring structures of joining. And at least then you're going to be so well armed when you are ready. You're not starting there
Yeah.
You know,
Yeah.
you're probably better off than the person who walks in and goes, "Hey, I've got 100 grand on deposit ready. Let's go." And it's like, well, you need some education. Like
Yeah.
coming in
Easy
with 10
tiger.
grand, coming in with 10 grand and joining and then sitting there for 6 months and listening to everything. You're going to actually then, when you're ready, be like, "Hey, look, I've got a
Yeah, you
strategy in
get it. You
mind. I've got a
understand it.
market in mind. I know how
Yep.
contracts work."
Yep.
Everything in between. Yeah.
Yeah.
Because people
Yeah.
forget buying property is a crazy process, right? You know, how many people are involved in a property transaction? It's
Oh,
mind numbing.
yeah. I think
Sometimes
we
it's
worked
super
out
frustrating.
130 or
You punch the
something.
wall sometimes with it. I always remember I used to joke and say, geez, I miss working at a bottle shop because someone would come in, take the beer and disappear. It was the one hit transaction. That was it. You'd never see them again. But property, obviously, you got multiple solicitors, there's defects period, accountants
That's
involved, brokers
massive.
involved, and
Yeah.
stuff like that. But yeah, I think and a lot of people, I think they don't want to do an investment property because they think, oh, we're saving for a home. And that's a big pitfall because actually, well, hang on, you've got 50 grand, you need 200 to buy your home. Like that, it's going to take you 7 years to save that 200. Don't you think putting that 50 into an investment is going to better your chances of getting to 200 faster? You're going to get depreciation from that property. You're going to get a capital growth from that property. You know, if not year one, come year 2 or 3 with the type of properties we work on, you're probably going to be sitting in positive cash flow territory even as well. So a lot of people think, oh no, I'll spend my money, it's spent. Well, it's actually not. You're putting it into an accruing asset to better your chances of a faster deposit saving process. So, real estate can be two things: saving money to buy that home, or it can be, something to just be a stepping stone to have on to all the way to retirement. So it depends how you want to play it.
Yeah. Don't start me on saving for stamp duty if you're buying a $2-3 million home.
Oh yeah,
You've got
expensive.
some big stamp duty
That's a
bills.
big
Yeah.
hit. I know. And that's an interesting one too. Like, imagine what's going to happen to the market. The government needs to fuel people buying real estate, and a huge problem with that is actually, someone having to fork out 150 grand to buy a $3 million home, which maybe in 10 years, $3 million homes is going to be the norm. Who knows?
Yeah.
So how long until maybe that becomes everywhere across the board? States adapting, $1,000, $2,000, $3,000 a year kind of thing, and then the market becomes a lot more open, more pressure, more people able to get into the field and play too. So there might be in the next little while. I think in the next 2 to 5 years there could be some real big changes in our country coming in terms of policy, state and federal based, grant orientated, or offsets for stamp duties, and a lot of changes in the real estate industry. Because obviously, it amount property and related services is north of 60% of our GDP, and what it is and isn't. So they have to do something to always make sure it's getting fueled and underway. Yeah.
Interesting. And just one final anecdote from myself before I ask Brennan if he's got anything else he wanted to add. I have had clients, one couple in particular, that built a portfolio. Now, they joined when they were a bit younger. They were in their mid-20s. They bought, I think it was about 5 or 6 properties, and they held those for a good 11 years. And they did choose to sell that portfolio down. Now, there were capital gains tax implications with that. They had to work with their accountant to make sure that, they minimized that as much as they could by selling over a couple of years and all of that kind of stuff. But they had a plan, because their intention was always to get some capital growth, to be able to add value to those properties, to enable them to buy their dream home in cash. And they succeeded in doing that. They ended up buying regionally by choice. But they did buy, they spent well over $1 million on a beautiful home out regional. And they did it all with cash. So, and now they have to start their investment journey again. But they're young enough to do another cycle and to build an investment portfolio. But now they don't have a mortgage on their home, and that worked really well. So there's so many different ways to use property to create options for yourself. So don't ever think that you're out of the market and you don't have options. I've had single mums that, have thought that there were no options for them. I've had people move home with their parents to save. you name it, and just get into the market. And it really
Yeah,
is about,
totally. And
getting that first step.
I've got property professional mates who are mid-40s, don't own a home. They own 6, 7 investment properties, and
Gotcha.
their interest is maybe getting something down the track. So yeah, there's so many ways to go about it. Definitely.
Well, especially if you're going to be nomadic, right? Why do you want to?
Yeah, exactly.
You're only going to rent it. Awesome. And so, Brennan, that famous question that we always ask at the end of every
Oh, hit me.
podcast: if you could go back in time and speak to young Brennan, knowing what you know today, what would you say to Brennan to, I don't know, change the trajectory?
I've kind of said it. It's been a bit of a theme
You
of
did.
mine throughout this, really, but it was just by what's possible when you can.
Yeah.
If you've got your heart set on one market but it's unachievable, explore another and get something, rather than spend another 5 years umming and ahhing and sitting on the fence
Can't
about it.
outsave
Because
the market, right?
totally, and the market that we have at the moment now is ever increasing information, and the speed of changes compared to previous market changes is so much. Our falls are sharper and faster, last a lesser amount of time. The rises are sharper and faster, and the changes to market are so it's just a game of doing what you can when you can, really. Definitely. Yeah, and look, I've got mates who done really well. I'm always bullied as the spruiker guy, the property spruiker. I always say to them, I'm like, listen here, mate. At the end of the day, if you just bought one of my deals, any one of my deals that me and my guys have been working on 5 years ago, you'd be up to $500,000 up. So you should have done something. You should have done
I'd
something.
buy your deals, Brennan.
Yeah.
We do, and we do. We for Positive Real Estate are cooks that eat their own cooking, or chefs that eat their own cooking. We are big fans of our team. All buying Positive Real Estate deals as well. So
100%.
we do take our medicine.
Yeah, exactly. Yeah, well, that's what, I did the gunner deals. I was doing deals there at the time. People would have still done well and had some great cash flow. They didn't have the bad soil like I did, which is good.
Awesome.
And obviously people who bought in Newcastle had a great time since we've been doing that as well. I think I did those deals with the same builders we work with. Some of them still work with today as well. So practice what you preach. Definitely.
Oh, fantastic. Well, thank you, my friend, for your time today. Much appreciated.
Awesome. It was good to come along. Good for a chin wag. I learned some stuff about you. I hope you learned some stuff about me.
I did.
I hope it wasn't too much of a absolute earful of bit of market jibber jabber. But I could speak for hours and hours on this kind of stuff, and that's just what happens when you're part of our team. I think it's constant.
We're passionate about real estate, aren't we?
Yeah, exactly. But thank you so much for having me.
Oh, thank you, Brennan. Awesome.
All right.
Bye for now.
See you, Tab. Speak to you soon.
Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.